Warren Buffett's investing advice for 2025. Do this now. Has the bull market finally ended? What should you do now? Can you still make money? I've been investing for almost a decade right now, and honestly, I'm feeling pretty optimistic because 2025 could very well be the start of a completely new cycle for you and I to build generational wealth. And here's why. Historically, whenever Warren Buffett acted carefully, like trimming his stock positions or issuing warnings in his annual shareholder letter, what came afterwards was a period of market caution. During the 1999 dot-com bubble, amidst of soaring technology stock valuations, Buffett warned us that our expectations were overly optimistic. And what happened after was 3 consecutive bearish years from 2000 to 2002. In March 2008, about 6 months before the biggest financial disaster in history of the US stock market, Warren Buffett warned against the overusage of derivatives because of the increased leverage and risk in our financial system. Now, Warren Buffett has recently expressed caution regarding the stock market. In his latest annual letter to Berkshire Hathaway shareholders, he highlighted a significant increase to the company's cash reserves, which skyrocketed to $334 billion by the end of 2024. This accumulation of cash suggests that Buffett's cautious stance towards the current market valuations. But before you think that Buffett is actually risk adverse whenever he expresses caution, let me show you some mind-blowing stats. Post-2008 global financial crisis, in 2008, Berkshire Hathaway's market cap was approximately $150 billion. But fast forward to 5 years later, at the end of 2013, Berkshire Hathaway's market cap increased to almost $300 billion. That's basically double in 5 years. Again, let's look at post-2020 pandemic. At the end of 2020, Berkshire Hathaway was approximately $540 billion. As of February 2025, it exceeded $1 trillion, reflecting almost another double in valuation again. A more shocking statistic came from the post-1999 dot-com bubble. So, for context, the stock market had 3 straight bearish years from 2000 to 2002 after the dot-com bubble collapsed, which quite literally means that most stock market investors had 3 years of losing years. Just when you thought that the early 2000s was a hard time to get rich from investing, Berkshire Hathaway's market cap grew from $85 billion in 1999 to $112 billion at the end of 2002. In that same time period. So when the overall market has gone down pretty bad, Berkshire Hathaway was growing, which is absolutely astonishing. Do you see a pattern now? In exactly 5 years after every major stock market crisis in the 21st century, Warren Buffett's holding company has seen an impressive return. So not only that Buffett publicly expressed his concerns whenever there's an upcoming crash, he also took advantage to accumulate wealth every single time. Now, let me ask you, would you rather buy high and sell even higher, or would you rather buy low and sell high? If the answer is obvious to you, I'm going to share my personal investing plan with you and how I'm planning to rebalance my portfolio. My portfolio's performance was the top 1% on Blossom last year because I concentrated my capital into tech stocks and the AI sector. Blossom is a social media app for investors. You could see the portfolios and holdings of other investors and learn from them. The link is in my description. You could download the Blossom app and follow me to see all of my stock portfolio and receive notifications when I buy and sell my shares. I'm going to share my macro market perspectives and my portfolio rebalancing strategies for stocks, real estate, and of course, cryptocurrencies. I hope by sharing my experience and strategies, I can help you guys approach investing the right way to start building wealth today. So make sure to do me a favor and drop a free like on this video, and let's see your performance 5 years from now. My personal market outlook based on key economic factors. Right now, the stock market feels a little bit uncertain. If you've been following the news or checking your portfolio, you might be wondering, has the bull market finally ended? Should I be worried about the bear market, or is there a short-term dip before another rally? To answer this, we need to look at a few key indicators to understand what's happening in the economy and how could it impact our investments. Number 1, consumer sentiment is dropping. So why does that matter? One of the most important signals we have is the consumer sentiment, which tells us how confident people are feeling about the economy. Think of it as a nationwide survey asking, how do you feel about your money, your job, and the economy? The latest University of Michigan Consumer Sentiment Report came in at 64.7, which is the lowest since November of 2023. That means people are feeling a little bit more worried than they were just a few months ago. So why is this important? Because the consumer spending drives about 70% of the US economy. When people are feeling confident, they spend more on shopping, travel, big purchases like cars and houses. When they feel uncertain, they might tighten their budgets and businesses make less money. And what makes people worried right now? Inflation concerns, rising interest rates, and political uncertainty. One big factor behind this is Trump's proposed tariffs on imports. If these tariffs go through, the prices of goods could rise, making everyday purchases more expensive. When people worry about high inflation costs, they start to spend less, which slows down the economy. So this drop in consumer sentiment is a red flag, but it doesn't mean that the market is going to crash. But it does mean we need to be more cautious and selective with our investments. Number 2, existing home sales is dropping. Another indicator that most investors use, including myself, is existing home sales. I know talking about housing data might not sound exciting, but this number is like the economy's temperature check. When people are buying houses, it usually means that they're feeling good about their financial future. When home sales drop, well, that's a sign that something might be off. Existing home sales measures how many homes are being sold in a given month that have been previously owned, so not newly built houses. This data is released every single month and is watched closely by economists, investors, and policymakers. Why? Because buying a home is one of the biggest financial decisions that most people will make in their lives. If people are buying homes, it shows that they are feeling confident in their job stability, income, and broader economy. On the other hand, if fewer homes are selling, it usually means that buyers are holding back, maybe because of high mortgage rates, job worries, or rising prices. So what's happening right now? Recently, existing home sales have been dropping. In fact, the most recent data shows that home sales fell to 4.08 million units, which is well below the market expectations of 4.29 million. That's not a small miss. That's a noticeable drop. What does that mean? Well, fewer people are buying homes right now. But why? There are a few key reasons. 1. Higher mortgage rates. When interest rates rise, monthly mortgage payments go up. So, for example, a $400,000 mortgage at a 3% interest rate might cost you around $1,686 per month. But at 7%, it jumps up to $2,661. That is a whole $1,000 more in your monthly mortgage payments. And that pushes a lot of potential buyers out of the market. Number 2, rising home prices. Even with fewer buyers, housing prices in many areas are still high. With high prices and higher borrowing costs, buying a home becomes a lot less affordable for the average person. 3, economic uncertainty. With worries about inflation, job security, and potentially new tariffs, some people are choosing to wait and see instead of making the big financial commitment like buying a home right now. And you might be wondering, Eric, why should I care about home sales if I'm not buying a home? It's simple. The housing market impacts the whole entire economy, which directly affects your investments. So, for example, buying a home triggers spendings on things like furniture and renovations. So fewer homes means less consumer spending, leading to weaker earnings for those companies in those sectors. Slower home sales also impacts home builders, mortgage companies, real estate stocks like Home Depot and Lowe's. So the stock prices of those blue chip companies will be impacted as well. The housing market often signals what's ahead. The prolonged slowdown can mean broader economic challenges and may push the Federal Reserve to cut rates sooner, which could boost the stock market. So if you invest in stocks and crypto, pay attention to home sales data as well, too. To me, weaker home sales are another signal of the economy cooling down, and that's not necessarily bad. Markets are cyclical, and slowdowns often brings in buying opportunities for patient investors. How I'm rebalancing my portfolio. With all the uncertainty in the markets right now, like slowing home sales, cautious consumer spending, and mixed signals from the Fed, my main goal as an investor is about positioning myself for the next market cycle. First of all, I'm reducing my exposure to tech. I've been heavily investing in tech for the last 2 years during the bull market, but nothing goes up forever. I'm trimming some of my tech exposures, specifically Meta, Microsoft, and especially Tesla. And there's a few reasons for this. First, valuations are getting stretched. Many tech stocks are priced for perfection, and with the economic data starting to slow down, I don't want to be overexposed to sectors that might be vulnerable for profit taking. Plus, when things take a turn, volatile stocks like the tech sector tend to take a hit harder. Second, interest rates may stay higher for longer. High growth tech companies often rely on cheap borrowing to fuel expansion. If rates remain elevated, that could put pressure on those valuations. And third, I believe in profit taking after a strong run. It's never a bad idea to lock in some gains, especially when a sector has been performing so extraordinarily well, such as what tech has been doing the last few years. Now, I'm not exiting tech entirely, just scaling back to a little bit more balanced and mindful of where things are heading. Where am I moving my money? So I'm rotating my capital to sectors that tend to hold up better in uncertain times. Sectors that offer stability, consistent cash flows, and opportunities regardless of where the economy is heading. One of those is healthcare. People don't stop needing medicine no matter what the economy is doing. Healthcare has historically been a defensive sector, which means that it tends to do better in weaker times. It provided that stability that I'm looking for while still offering steady growth opportunities. I'm also looking at financial companies like banks. There's talks about possible rate cuts down the road, and if that happens, banks could benefit from increased lending activities. Plus, many financial stocks are still trading at reasonable valuations, which is appealing during times of uncertainty. In addition to the macro tailwinds that we are expected to see in the Trump administration. He's been a vocal proponent of deregulation, which has the M&A industry surging back to life. Deal makers are salivating to get back into the market, and the IPO market is starting to see some life after a pretty quiet past couple of years. And lastly, the consumer staples sector is another area that I'm watching. Consumer staples is stuff that you absolutely need, like toilet paper, toothpaste, and groceries. So these are retailers like Walmart and Costco. People will still need to buy toilet paper regardless of whatever the economic conditions are, unless you're a barbarian who doesn't wipe. But I won't judge you, maybe just a little bit. Most of these retailers also often pay a modest dividend, which could help offset a little bit of that volatility. Now let's talk about crypto. Many of you guys started following me after seeing my content around crypto. I know the sentiment right now is pretty negative. Headlines are all over the place, and we just had the largest crypto hack in history. Volatility is back, and many investors are stepping to the sidelines. But personally, I'm still buying. Right now, crypto is in what I call the fear phase. The market sentiment is bearish, and when you look at the historical data, periods of extreme fear have often been some of the best times to accumulate long-term positions. That's a simple concept. Buy when others are fearful and sell when others are greedy. But it's easier said than done, because when the markets drop, our emotions really tell us to step back. And this is where having a plan helps you stay consistent. And that's why dollar cost averaging, or DCA, is my preferred method of buying high conviction projects like Bitcoin and Ethereum. With DCA, you're investing a fixed amount at a regular interval, whether that's weekly, bi-weekly, monthly, whatever it might be, regardless of whatever the price is doing. It takes the emotion out of the equation. You're not trying to time the bottom. Instead, you're accumulating assets over time, smoothing out the highs and lows. Crypto is very volatile. It could swing 10% or more in a single day. Trying to time those moves perfectly is tough, even for professional traders. By sticking to a DCA strategy, I don't have to stress whether or not the prices are going higher or it's going to drop further or whatever that might be. I'm focused on the long-term picture. There are many fear-driven events right now, but I think fear often creates opportunities. Markets tend to overreact on bad news in the short term, and if you believe in long-term potential of blockchain technology, decentralized finance, and the overall growth of the crypto space, these pullbacks can be the time to accumulate at lower prices. Of course, I'm not saying to go all in. Risk management is key. Crypto markets are very volatile, so that's why I personally just say dollar cost average, because I can't ever tell you where the market will go. I'm also keeping an eye on developments in the decentralized infrastructure and AI-related blockchain projects, but my core focus remains in quality assets with long-term potentials like Bitcoin and Ethereum. What is your strategy going forward? Do you think that the bear market is coming, or are we in a short-term pullback? Let me know your thoughts. If you're getting started in your investing journey, I have a quick start investing guide for you. Go ahead and sign up for my free newsletter below in this video, and you will receive my quick start investing guide and my portfolio updates. And please do me a favor, don't forget to drop a like and subscribe to this channel, and I will see you next video.